mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome back, everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. First question, we have this question from Andrew. He says, the stock market has had a good run. So if interest rates go down, do you think the stock market will continue to run upward, I'm assuming? All right, Andrew, at least you're paying attention, and I love that. Thank you. And you're probably talking about kind of the Warren Buffett thing that I talk about sometimes, right? And that's when interest rates go down, the value of all financial assets go up. But the stock market is even more complex than the bond market. There are various factors at play. Now, a lot of analysts would say the stock market is already slightly overvalued today, but let's look how it got there, right? First of all, in 2022, when the Fed was aggressively raising rates, the stock market dropped. I think the S&P 500 was down 18%. It was a really tough year. Now, we have high dividend stock strategies that were up that year because they don't track the overall market, right? So you had to be more of a stock picker. But then when the Fed announced it was close to stopping raising rates, let's say in the spring of last year, all of a sudden the market took off. But what part of the market took off? Well, the technology part, right, Andrew? That's the part because the market knew the Fed was going to stop raising rates within a year and a half and then lower rates, right? Which of course they did. They stopped raising rates last summer and they just lowered rates in September. So it's been about a year and a quarter, let's say. Therefore, when rates go down, typically the growth stocks tend to do the best. The tech stocks that don't pay a dividend because the markets are forward-looking. They started to drive up these tech stocks in the second quarter of 2023, right through today, really. And, you know, they're still going up a little, but the question becomes, what's going to happen next? So do I think the stock market could still do well? Yeah, sure. Do I think it's going to be as great as it was in 2023? Probably not. We'll see. I mean, we're a good way through 2024, and we're doing all right, but it's going to be a different part of the market that's accelerating, right? Because the impact of interest rates coming down on those zero dividend growth stocks has already been felt, and I think the next phase is going to be more of the high dividend play. Why? Because those stocks, so people have been able to get 5-6% interest in bonds, right? And they didn't need to take the risk of high dividend stocks. But as the Fed lowers interest rates, those high dividend stocks are going to look more attractive for retirees and people approaching retirement. So the market will still do reasonably well, but there's going to be a bit of a rotation, I believe, from where we've seen the growth in the market to where we're going to see the growth in the market through the year 2025. So again, my crystal ball, best guess, Andrew, hope that helps. And if you have any more questions about investing for income, especially as you approach retirement, always feel free to ask. Hey, thanks for that great question, Andrew. And if you have a question that you would like answered, you can send it in to me. Send it to poolelock@poolelocke.com. Moving right on to our second question today. It's from Madeline. She says, I'm more conservative than my husband. We really don't agree on the stock bond mix for our shared portfolios. Do you have any suggestions? So, Madeline, one of you could be right and one of you could be wrong when you look at kind of the left brain side of it, when you consider how much income you need to retire. If you need every bit of income from your portfolio, then you've got to lean more towards bonds and bond-like instruments to get higher income flow. If you don't need as much, then let's say your husband is more aggressive and you're more conservative, he might be right? You might be able to take a little bit more risk and get lower income yield, right? That's the left brain math side of it. Or you might be actually so far behind the eight ball that you might say, well, listen, we haven't saved enough and we need to take a little bit more risk and try to get there, but we're going to be working forever. So that's possible too. But let's say you have enough to retire, and those restrictions are not an option, right? Now it comes down to your comfort level. It comes down to whether you can sleep at night if you see a drop in your portfolio, and how much of a drop can you tolerate. As with everything in relationships, it's all about compromise, right? For example, think of a relationship like a road trip. Sometimes you might want to take the scenic route to enjoy the view, while your family prefers the fastest route to reach the destination quickly. So compromise is like finding a middle ground, where you take the scenic route for part of the journey and then switch to the faster route. This way, everyone gets a bit of what they want, and the journey remains enjoyable for all. Just like in relationships, finding that balance ensures everyone feels valued and the journey together is harmonious. So you have to compromise. How do you compromise? First of all, you could split the difference. If he wants 60% in stocks and you want 20, maybe 40 is the number. What else can you do? Maybe put a little bit in stocks, but use high dividend stocks. High dividend stocks are a little bit more conservative. So maybe he can still feel like he's got a bit, with the upside potential and a higher percentage of the money, but you can feel like you've got a little more downside protection. Typically, high dividend stocks don't drop as much as growth stocks in a bad economy. Also, you have a little more income, so you could feel comfortable there. So again, there's the left brain math side, which to me is going to point to one or the other being more right. And then when you get past that, it comes to the subjective side and just finding ways to compromise. No silver bullet there, Madeline. I'm sorry, I wish I had one for you, but hopefully you guys can work this out. Additionally, consider diversifying your portfolio with a mix of both stocks and bonds that align with both of your risk tolerances. You might also look, into income-generating investments like real estate or dividend, like I said, the dividend-paying stocks, which can provide a steady income stream while offering some growth potential, right? Consulting with an income specialist could also help both of you find a balanced approach that meets your retirement goals and comfort levels. Madeline, I hope this helps. If you have more questions about investing for income as you approach retirement, always feel free to ask. Thanks, Madeline. Great questions today. If you want to send in your question, you can do so. Email it to poollocke@poollocke.com. And if you like what you heard, go ahead, like and subscribe to our channel. I'm James Locke, your retirement income source. See you guys next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the